answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain.
Glad you are with us today. Both myself and my co-host here. We're both financial advisors, certified financial planner, chartered financial consultant. We spend our weekdays with people like yourself. We broadcast our program on the weekends to be your financial advisors on the air. And it's always good to have you with us. If you've been a listener for a while, you know most of the topics we talk about are retirement-related issues when it comes to finances and making sure things are structured well with your finances. And we cover things all the way from investments, 401ks, IRAs, how do you create a retirement income stream, mortgages, reverse mortgages, insurances,
Roth conversions,
long-term care, taxes. Everything that has to do with that sounds pretty exciting.
Minor estate planning.
People are starting to change.
Yeah.
Just drop the program
They're
now.
like,
my God.
I thought this was
I think we'll go to the gardening show.
I thought this was the crop report.
The crop report.
You ever listen to the crop report?
I have. No, I don't listen to it.
Yeah. It runs early morning.
I have tremendous respect for farmers. I have zero desire to be one.
Oh, it would
Less than zero.
It is. It's quite.
That is a hard business.
Oh.
I mean, you can imagine the volatility of the price for your product.
I would think
you manufacture a product and then you're not even sure what kind of price you're going to get for it.
Yes.
Every year it changes dramatically.
Yes, and as do the inputs.
Yes.
The cost of fuel,
labor,
machinery. Anyway, I think probably the worst business to be right now would be restaurants or ski resorts or hotels or
well, ski resorts are open.
Yes.
The restaurants.
Yeah.
My heart breaks for.
Every state is different. I have a friend in Miami sent me this thing of he was at a party, a restaurant. It looked like 2018. I mean, people were running around. Every state is completely different. We're in the state of California.
Yeah. We're not going to talk about those issues because this is a financial program, and for whatever reason, it all became politicized. So we don't want to go down that path.
The corona's real.
I tell you, we'll do takeout food to go, and then now in the area of California where we reside, you can go to restaurants outside, and it's California, so there's decent weather some nights, and I am so grateful to the people that are still showing up working because they weren't working a couple weeks ago. Now they're back working again, and I tip very well, and even on to-go food, I tip very well, and I just feel bad for those.
It's terrible.
Folks.
Yeah.
Why are we talking about it? It's depressing.
Okay, let's talk financial numbers.
Why don't we start off with the calls? Make it a little more interesting. If you want to be part of our program, we'd love to take your call. To join us, it's toll free 833-99-WORTH. That'll get you on Allworth's Money Matters. 833-99-WORTH, or numerically, it's 833-999-6784. Also, I know that we have actually, I think, more podcast listeners than we have radio program listeners. And if you'd like to schedule a time to be on our program, you can also email us at questions@moneymatters.com. Again, questions@moneymatters.com, and someone will get back to you and schedule a time when we are in the studio recording radio calls, and we'll take your call that way, and we'd love to do so. So again, it's the telephone number is 833-99-WORTH, and the email is questions@moneymatters.com. And we're starting in Northern California, talking with Sue. Sue, you're with Allworth's Money Matters.
Hi, guys. Love your show, and thanks for taking my call. And my sentiments are with you 100% about the restaurants.
Oh, it's rough.
Luckily, up here in the Sacramento greater area, a lot of them are open indoor dinings. But anyways.
I don't think they're supposed to be, but yeah. Okay.
I know. It's those rebels that we love. So my question is, my kids, their grandmother gave them $13,000 each for a Christmas present, and they, right now, it's just sitting in a bank account. So where should we put that money?
How old are your kids?
15.
And what do you think they're going to do with the money?
Twins or triplets? What do you have?
Yep, trips.
You have
Do you
triplets?
really?
Oh my gosh.
A good guess,
Yeah,
Scott.
we do.
Well, I was going to say twins, and I thought, I might as well say triplets every once in a while. It does happen.
Yeah.
Wow.
Throw it out there.
15. Boys
Wow.
or girls?
2 boys and a girl.
Oh, that has got to be interesting.
So it's really great. Good kids. We're lucky.
I can only imagine the first 12 months.
Yeah, that was probably the toughest.
Yeah.
Ignorance is bliss.
So what do you think the intent of these monies will be? How do you think they'll be spent, if they will be spent?
I know, that's hard to say because they might want to use some of it for a car. One of them has money already, some money saved up for a car from playing Fortnite, of all things.
Uh-huh.
Isn't that funny?
Isn't it great?
So it is funny because he got both stimulus checks too. Which
Isn't
really
that awesome? Isn't that's so good? Because
It's so bad.
We
So
know
Wait a
that-
minute. Is he not a dependent?
he is a dependent,
it didn't matter.
but he had to file taxes for winning a couple $1,000s last year, and so we looked at his checking account. He's like, "Mom, why do I have
God,
this
it's
money?" I said,
unbelievable.
"I have no." Yeah,
Hey,
and he
Sue,
didn't have the
I'm
second
all
one.
for people that have been impacted through this pandemic, restaurants, like if the
I
government's going to
agree.
shut things down, then the government can also step aside and help those that need it. But
But
when I hear
your
about
son's for getting the
And by the
money
way,
for Fortnite?
yeah, Susan, Granite Bay.
Oh.
Granite Bay is not exactly a low income neighborhood in
It's very nice.
in California.
It's very nice. But Sue, not to one up you, my son,
Not to one up.
but here you go. But here, I have a son that was in college working on campus, was laid off because of the pandemic. His state unemployment was $84 a week. His federal unemployment was $600 a week. This kid has never made more money in his whole entire life.
Get out!
So he's getting $684 a week for a period of time. And he said to me, now explain the economics of why I should go back and get a job, Dad.
You said that's exactly why we pay all these taxes.
Exactly.
Because of things like this.
So
Yeah, it's sad.
do you think they'll use it for college? Do they need it for college?
No, they don't need it for college.
And is Grandma? 2 questions on this. One, will Grandma likely do this every year? Because typically, it's you have a larger state and you're trying to get some money out of the state. Will she do this every year?
Right.
And maybe as more importantly, like, what are her thoughts of how these dollars should be spent?
I don't think she really has a concern of how they're spent other than, just not frivolously. She actually did it this year just before Biden got into office because she was worried about tax consequences. So she gave it to all of her grandkids. I don't know that she'll do it
Got it. Yep.
next year. But versus just sitting in a savings account, we just wondered if there was something we could do that would help it grow.
If it was long term, and that's 5+ years, I'd buy the S&P 500.
5+ S&P. Okay.
And if I wasn't sure, I'd actually buy half the S&P 500 and keep the other half in the bank.
Okay.
For the one that has
that's
been
great.
making money
Great
on
advice.
gaming, whatever
Yeah.
his. It's a strange world. Whatever his net income was for 2020, he can make a Roth IRA contribution.
Contribution.
He's got up until April 15th to do so.
And thank you, Scott. I was going to follow up with that. So any of their
Roth
income.
IRA contribution, okay.
And the more,
For what he made in 220?
That's right. That's right. He
the,
can go
the
up to
maximum
100.
is $6,000. Is it $6,000 or $6,500 last year for IRA contribution? Something like that. How much did he make?
She said a couple thousand, right?
I think he made probably 3,000 total.
Yeah, so he could put 100% in, 100% of his income
Okay.
in there. So he should do that, and that should
Up to $6,000.
up to $6,000. He should do that for and buy the S&P 500. And if I was
Or total stock market.
Even better.
I would do total stock market index.
By the total stock market index.
That's going to be long-term money.
And so for the kids you don't know, you split the difference. Half in bank, half in the S&P.
And you might want to do something like depending. It's not easy trying to teach your kids financial principles and discipline when you live in a somewhat affluent society, right? So like,
well, I mean, we're not we don't roll in money.
I'm not. I didn't assume that. It's just relative.
I wish we did.
Okay, relative to the typical middle class family today is much different than it was 30 years ago or 50 years ago. But one thing you could do, you could say, look, we'll use some of these dollars for your car, but it'll be matched dollar for dollar of what you're going to contribute, or something along those lines.
We've offered that. Yep. These are great. I love the Roth IRA. Oh, wait, that is, yes.
That's right. That's right.
And then you could also use the 529 plan. It's for education when the money's used for their college expenses.
But they're 15.
What do you mean?
She doesn't think they're going to need to use the money for education. And the tax deferral on that is such a short period of time. Why would you bother? I don't mean to be argumentative, but I am right. No, I would just split if I was uncertain, I'd put half of it, as Scott was correct, in the total market, and then the other half I'd leave in cash. And
as any of them have any jobs, any sort of wage income, convert those dollars. Or no, it's not technically conversion, but take some of those dollars saved or invested in the S&P 5 or total stock market fund and put that into Roths.
Okay.
So if one of them gets a job at Chick-fil-A next year and earns $3,000, then you can say, all right, we're going to take $3,000 of your dollars and we'll put it into a Roth IRA. It's amazing how they start compounding over time, and then there'll be a time when they're down the road and they're like, oh man, there's a lot of money saved up in here. And they can always take out their contributions without any tax limitations or impact. Any of their earnings need to stay there until their retirement age.
Oh, wow. Okay.
All righty.
Great information. All right. Well, thank you guys so much. Really
Thanks, Sue.
appreciate it.
Take care.
Take care.
Glad
Bye-bye.
you called, Sue. I had a friend whose son, he made over $100,000 in high school on YouTube.
Was he doing tutorials on how to play video games?
Correct.
Yes.
And had a bunch of followers.
Yeah.
And over $100,000
in 1 year.
Yes. Oh yeah.
He was an indoor kid.
He was that year, that's for sure. But the challenge, he was 17 at the time, 18. Like his dad says, you need to get an account, you need to have some money set up. I talked to the kid, like save 40% of whatever comes in.
I know. What do you get that kind of money at 17, right?
It ended up not working. I mean, it was not helpful for him.
It made it worse.
Long term, it might be good, but it wasn't. I mean, just some of the choices made as a result.
Was he driving around like in a BMW or a Hummer or something like that?
He had a Land Rover.
Okay, well, that's yeah.
But actually, my friend said it turned out to be the best thing he made because when he. At the end of the day, that's the only thing he had left when it was said and done. And then
everything else was.
It helped go pay the part of his tax bill until he was able to get a.
Because that $100,000 didn't continue year after year after year.
No.
It just reminds me. I lived across the street. The house I live in now, the people lived across the street, and I was talking to the lady. Like we had lived there for 2 years, and she had mentioned her kids, and I said, you have kids? She goes, well, they're not really mine. They're stepkids. And then she explained it to me, and I said, I've never seen them. And she said, well, they're indoor kids.
I remember you telling me that.
I said, what's an indoor? Is it like an indoor cat where they never go outside?
We have one of those.
We have an indoor cat?
Yeah.
So she said that she described her stepchildren as indoor kids. And I said, because I've never seen them. And she said, there's a good chance you'll never see them. They just leave the house, get in the car, I drive them to school, and then they come in and they go back in the house. And I said, oh. Okay. Well,
is this family still together?
They moved.
That doesn't sound like a very healthy way to view your stepkids. My goodness. Maybe a little family counseling would be helpful there.
Yeah, stepkids, you'd call them indoor
ripping
kids.
on your Still, kids, that does not sound healthy. All right, 833. We are way off topic. 833-99-WORTH is to be part of the program. By the way, if you haven't been on our website in a while, allworthfinancial.com. We've got some great information there on retirement. We've got our whole learning library where you can go through and some great courses to take on retirement topics. If you're looking for information on Social Security timing or Roth conversions, or just even how do you structure yourself? Are you ready for retirement? Do you have enough money so you're not going to outlive your retirement? Allworthfinancial.com's got a lot of great resources on there, and encourage you to check it out if you haven't in a while. Let's go to the phones, talk to Alejandro. Alejandro, you're with Allworth's Money Matters.
Hi, Scott. Hi, Pat. How you guys doing today?
We're great. Thank you.
Thank you guys for taking my call. So I'm 33 years old. I work for a law enforcement department here in Sacramento County, and we're one of the law enforcement departments that actually pay into Social Security. We have our pension as well. We have I'm the 2.7 at 57, and I guess my question is my pension going to knock out my Social Security in the future with the windfall elimination?
Not if you're contributing. The windfall elimination occurs when people are not contributing to Social Security.
And they had contributed at some point in the past. So it typically applies to, what you see it mostly is in the state of California, is teachers, not administrators, but teachers. And even that varies from district to district. But 2.7 at age 57, what may knock out your Social Security is changes in tax law or changes in how they measure your need for Social Security. So you're talking 24 years in the future.
Well, how old are you today?
Yep.
It's 33.
33.
So you're talking about
it's
24
a long ways away.
years until you retire.
Plan your retirement for no Social Security.
Plan your retirement as if you're not going to get a dime in Social Security.
Yeah, that's my thoughts. I figured Social Security would just be a cherry on top. Yeah, I put into my Roth, and then I'm opening a Roth IRA, but and then I have my pension, of course. I just figured Social Security would be a bonus on top. But I had heard that there was an option of opting out of Social Security. Is that something that's even possible, or is that just? It's
not by an individual, and that time has passed years and years ago. This is a little archaic to the state of California. Certain departments at the state of California decided to opt out, but not all did.
Okay.
So if your department did not opt out,
all of Sacramento County's law enforcement, I guess, still pays Social Security.
That's right. And so you've got 32 years before you actually are eligible for Social Security under the current rules, age 65. But I expect that it will be 67 or 68 or 69 by the time you get there. And you're retirement eligible at age 57. So obviously you've got some time in there. Are you frontline law enforcement? Are you in the street?
Yes, sir. Yeah,
Thank you.
Thank you.
a B cop.
Thank you.
Thank you. It is a tough job right now. I have a friend.
Definitely.
I have a friend that recruits for law enforcement, and they're struggling to get people to join the force for two reasons.
Yeah, I've heard of a lot of people retiring early because of it. Because of what's going on in the world.
Well, we appreciate you being there.
Yeah, we would be a world of hurt
Thank you very much.
without people like yourself. So thank you and appreciate the call. Yeah, what would the?
What? We'll see. We'll see.
We'll see what.
What it's like without as much law enforcement. Some of the experiments in different cities will tell us how it's going to work here in the next year or two.
And Social Security, if you're young, like Social Security, the trust fund's going to be broke by 2030, 2031, 2032, depending on. It's not very many years. It's 9 years out now before we don't have enough money coming in to cover those expenditures. If you're 20 years away from Social Security, plan on it not being there for you.
You have to. Yeah, because the reality is, if you actually make a good living and save well, there will be most likely there will be needs-based testing in order to determine
who knows really what's going to happen. But you're better off to plan like it's not going to be there, and if you get something, great. But plan like there will be no Social Security coming in, because that's.
Yeah, and speaking of that,
of Social Security,
about planning for retirement. The outlook for financial security for workers aged 30 to 59 deteriorated in the year 2020. So this is a sentiment scoring that the Boston College has done year over year over year.
And Boston College has done a good job on retirement studies, and for whatever reason, they're one.
But this is, and the reason I bring this up is because this is Alejandro is 33, relatively new in his career, falls into this 30 to 59 age, as do I, as does Mr. Hansen. But 51% of households now have a feeling that they're not going to be able to maintain their standard of living in retirement. And that's up slightly from the year 2019, which was 49%.
How many? So 51% believe they're not going to be able to maintain their standard of living in retirement. What percentage of current retirees can't maintain their standard of living they had pre-retirement?
Probably that.
If not more, right?
Yeah, probably that. So there's two ways to address this. One is change your standard of living before retirement, or save more, which would require you to change your standard of living before retirement.
You know, here's an interesting thing, and I don't see a lot written on this, but here's what we've witnessed as being in this industry for 30 years. Here's a very typical situation, right? A typical situation, there's going to be a man and a woman having children. Typical situation, most of the time married, husband and wife married. Kids during the workplace, either one of the spouses isn't working full-time or isn't working at all, or there's a lot of other expenditures with
or there's a big differentiation in incomes.
Then there's the kids that go off to college of some sort or trade schools. So there's a lot of expenditures, but then the time comes when the kids are pretty much gone. They might still be living at home or back and bouncing back and forth, but they're not costing the parents much at all anymore. That's number one. Number two, typically people are at their highest wage time
in their 50s.
Let's say their 50s, right? Their highest wage time. And oftentimes people's standard of living will increase, sometimes dramatically, during their 50s and early 60s as they're preparing for retirement.
When it really should either stay the same or decrease.
Depending on how much they have saved for retirement or whatnot.
Correct.
And not that retirement's some nirvana that we all need to shoot for, but look, roughly half of us are going to retire earlier than we had planned because of a health issue, a change in our job situation, right? We all know people that it's occurred to. That could be you as well. So making sure you're prepared for retirement is important. But we've certainly seen a lot of people who have increased their standard of living. They haven't saved as much as they should. Now it's like a double whammy when they go to retire, because now instead of trying to replace $70,000 of income, now we're trying to place $110,000 or whatever the number is.
Scott, when you say this, it reminds me of a client years and years, still a client of the firm years ago. They retired from one job in their mid-50s and started receiving a pension. Went back and took another job that was of the same pay the job they left. So their income went up by, went from, let's say, $100,000 to $180,000 overnight. And they were intent on spending every dime of that. And I told them, I said, my guess is you're gonna probably go out and buy yourself a $5,000 grill and a big hot tub and put a new pool in, and travel more and buy new cars and put some debt on it. I said, this is a dangerous thing. And they started laughing. And I said, why are you laughing? They said, we already bought the barbecue and we're going to the spa place tomorrow to look for the hot tubs. And we have already booked the trips. I said, this is a dangerous, dangerous place you're getting to, which is you're increasing your standard of living before an ultimate retirement date, in which case you're going to have to decrease your standard of living. So what we really should do is just keep it the same and pretend that extra income was never, ever there and save more of it for retirement. And there was a reset. That's what we ended up doing with them.
And
they've retired comfortably, 4 years, 5 years in the future. But this windfall wasn't going to last forever. And what I didn't want them to do is increase their standard of living only to be disappointed in retirement.
And we've seen that a number of times. That's why I think the planning as you're going as you're approaching retirement, that planning for your retirement shouldn't happen like a year before you retire or 6 months before you retire or a month before you retire. Really like several years out prior to retirement.
But people really start taking it seriously, I think, when they're in their 50s. They save and save and save and save and save. Most good savers will save, or people that are worried about the future. And then in their 50s, they start counting
our own firm, our average age of a new client is 57 years old.
Yes.
And most people come to us for retirement planning. We have roughly 13,000 clients spread out across the country. And people come to us to help with the overall financial planning going into retirement. I think that's probably typical for a lot of people when they
Yes. Just where they're at in the life cycle.
But if you find yourself, if that kind of this story just resonated with you, maybe a good time to get a good financial advisor. Sometimes just even having an independent person being able to say, here's where the new guardrails need to be, and here's what you need to be saving will be helpful for you and get you, just help us.
It's worth the time and energy.
Absolutely. We're going to take a quick break. When we return, we'll take some of your calls again. 833-99-WORTH is the number. You're listening to Allworth's Money Matters.
Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McClain.
To be part of the program, 833-99-WORTH is the number. Join our show.
You sound pretty excited about it. If you're not doing anything. Where's the young enthusiastic Scott Hansen that we all used to know and love?
I'm not young. I'm still enthusiastic. It's funny. I was I really enjoy mountain biking. I enjoy being around people, and I enjoy being active. And if I can do those things, two things together, I really have a great time. That's just me. But I was riding the other day with my buddy who's about 50, and I said, you know what I like about mountain biking? One of the things I like. I said, I look in the mirror in the morning, and I see this old guy, and I get out on the trails, and I feel like a kid again.
And the 50-year-old then crushed you up a hill, didn't he?
No.
No, you beat him?
I'm about the same age. I'm 54.
Oh, I thought you were older.
54, 50, what is this?
I have been riding.
Well, the other day we passed about 15 people. No one passed up. Passed 11.
Oh, look
kids.
at you.
Oh, yeah. Oh, that's important. That's an important thing.
Look I was so much better than those people I don't even know.
Plenty of people can crush me out on the trails, I'll tell you that much.
Yes.
Anyway, why did I bring that up?
I don't know.
You said something about young and enthusiastic,
Yes.
and I get a little glimpse of age.
Yeah, and you were coming
fortunate.
to your own defense, which
very
was
fortunate.
very nice.
And I am excited about this program because it's a fantastic show.
It is.
Frankly, we've been doing this for 25 years, in part as a way for, I shouldn't say giving back. I don't even like that term, but it's like, obviously, it's been good for business over the years. It's good for our brand recognition and stuff. There's no question about it.
No question.
But it's also, I feel good about it because there's a lot of people that will not come see a financial advisor for a variety of reasons, or don't have the financial resources to see a financial advisor, or don't know whom to trust or whatnot. And I think this is a great...
Yeah, it's a forum. It's a nice forum.
And you listen long enough, you're going to learn a lot.
Hope. That's our hope.
Well, if not, that's your fault.
Well, we don't know what their baseline to start with is.
If someone's been listening for 25 years...
They probably learned
I would hope so.
I know I have.
Listening to yourself?
I did listen to myself a couple weeks ago. I listened to the show.
My daughter did it. We did a video. She's a class representative for her class. They had to do a little video, COVID.
Who do they represent?
The class.
To who?
She goes to, they're actually in person.
Who is she representing the class to? The administration?
The student counselor.
Okay.
So they had a fourth grade class representative. And so they had to do a little video. So I did a little video with her. It took her, about 10 times or something to get it pretty good. And then, I tried playing it back to her. She couldn't. That doesn't sound like me at all. I think it does sound like
When
me.
did this happen?
Like a week ago.
Oh.
She's 10, fourth grade. And So the video, I guess there were like 7 kids that were going to go for this. The class votes on them.
Yes.
But they were supposed to do a video. Only 2 kids did a video. She did a video, and some other guy did a video. And she comes home. She says, "Yeah, I think I'm going to win." It's like, well, how do you know? She says, "Well, I know every girl's going to vote for me." I said, "Well, how do you know that?" I asked him. I said, "What do you mean you asked him?" "Oh, yeah." I said, "You like walk up to him and say, 'Will you vote for me?'" "Yeah, that's exactly what I did, Dad." So I now call her misrepresentative.
Do you have to? Special? She wear a special hat or anything? But are they in?
I don't know if
they're
really
in
do
person.
anything. My oldest daughter was president of the middle school when she was in 8th grade. She did nothing. I kind of wonder what they're.
Your 4th graders back in class though.
Yeah.
Full time or part time?
And for a little over 4 hours. It's a charter school.
Oh, got it.
That's why it's a charter school. But my 13-year-old goes 2.5 hours a day.
Which is about the usable amount of time
For a junior high kid.
for a junior high kid.
I mean, in some aspects, it might not be that bad because then she comes home and does a couple hours of the homework. She complains about how much homework she has and think, well, it's
yeah.
I'm doing homework too. Most days I'm working from home.
There's a lot of wasted time in the classroom. Actually, I remember when my oldest, they put Chromebooks in the classroom for the first time, and he quit having homework. And I said, "Why don't you have homework anymore?"
He did it during class.
He said, "I do it during
Did you do
class."
that in high school?
And a little, not a lot. I was really attentive when I was in high school. I was zoomed in on the teacher.
Yeah, that's bad. That's your attentive, particularly for long periods of time.
That's why they call me.
Pat loves the 3-hour meetings.
That's why they call me the Oak.
You do a long Zoom meeting with Pat, and he is right there, engaged 100% on that screen.
I know. I'm playing tic-tac-toe.
You were yelling at someone in your yard the other day. I'm doing a Zoom call with Pat. You get up. Oh, no. I'm like, who are you yelling at? It's hilarious. We all have our Zoom moments because I think a lot of us.
Yes.
Anyway,
let's go to the calls
because we can sit and talk forever. We're talking.
I thought I muted myself before I yelled out the.
No, you didn't.
I did not.
It's hilarious. Oh, come through the side gate. I don't know if it was the gardener or somebody was there.
There's a guy working on my pool, which sounds pretentious, but I do have a pool.
Sound pretentious.
I do have a pool. I'm going to admit it.
All right, let's talk with Tony. Tony, you're with Allworth Money Matters.
Thank you so much for taking my phone call. I have a quick question. I've been doing a lot of reading, and the moral of the story is everything that I keep reading, it says actively managed funds over the long term don't really outperform the S&P 500. Like one article I was reading, it said even after 1 year, about 65% of actively managed funds don't outperform, and as a 15-year return, almost 92% of actively managed funds don't outperform the S&P 500.
Not only that,
being said, is
not
it
only that,
smarter
Tony,
to buy the S&P 500?
There are some that say those that have outperformed the S&P 500 or whatever index, their underlying index that would be appropriate for them to track. Maybe it's just a matter of luck, right? You get 100 people in a room, give them all a quarter, and say, "I want you to keep flipping a quarter until you see how many heads in a row you'll get." Well, some person's going to suddenly look like a genius. They got heads 10 times in a row. Like they know how to flip a head.
Exactly.
Right? And so some of it, some studies say it's pure luck if you can outperform them. Which is why you've seen now the majority of money in mutual funds are in passive investments. They're index funds. The majority of money in mutual funds and ETFs are in passive products.
Is that all money or money going in?
All money in mutual fund, not all money in equities.
No, I understand that.
All money currently today, not flows.
Not
flows. The vast majority.
Yeah, the vast majority of flows are going in.
But of just holdings.
But in saying that, you may want to use some. It depends on how deep you go into the portfolio because it may make sense to use some around the edges. Active management.
Well, that's what I was really wondering because the main article I was reading mainly talked about large cap, but they also talk about mid and small cap, and there was about 80 to 90% on the small cap.
Same thing.
Is it just better to buy the index for the large cap and mid cap as well?
Well, I mean, here at Allworth, the majority of our assets are in index funds, We use some active
Okay.
managers, actually more in the fixed income space. For some reason, we believe that. Actually, studies have shown that but we have a lot in the index and in fixed income as well.
but we'll use actively managed around the edges.
And
so
the key is to make sure they're low cost active
yeah.
managed.
So when we say around the edges, if we're using some sort of esoteric debt, or if we're using some international or small cap international or medium cap international, we'll use those actively managed around, because what we're trying to do is actively avoid something, not necessarily buy into something, but we're actually trying to avoid certain things in the active management side. But for the average investor, having most of the money into a index fund, there's nothing wrong with that.
Nope.
Nothing at all.
Okay. Well, that answers the question.
How are you currently invested?
I have most of my money is in the S&P 500, and I have in index funds and small and mid and international. So that's kind of why I was wondering.
Yeah, you're fine.
The challenge on pick. How do you pick? The question is, if you're going to use an active manager, how do you pick which manager? Do you pick
exactly?
Because you don't want to pick the one that was the top performer last year.
Well,
that
no,
just
because
probably
like
happened
you
to do with
said,
the
it
asset
might be
classes. Might have been total luck.
Exactly, and that's when I kept seeing that 92%. I'm all, well, there's no way I can pick the next winner.
But here's what's interesting, right? So we look at today where you've got the majority of funds and mutual funds and ETFs are in index funds, where according to the studies you just said, 92% or whatever the number is of active managers don't outperform the indexes. At the same time, we have these apps that individual investors are doing they're not picking index funds. They're picking individual stocks.
The apps are. Or they're promoting them.
The investors are through the apps.
Correct. Through the apps, they're promoting them.
Even E-Trade, all those things. I mean, not to pick on any particular company. E-Trade, they got the ad like investing so easy a baby can do it. They said little baby and stuff from that. Like, if
No, and I totally understand that. And that's why I've always considered myself more of an investor than a trader.
Yeah,
perfect.
Because I think some of those apps are really targeted towards traders, but I could be totally wrong.
No, I think you're right. I think that's the whole idea behind them, because the companies actually make money on what's called deal flow.
Yeah,
that's how they make money, is on
the more
deal
trades,
flow.
the better for them.
Yes.
Period.
Even if it doesn't actually cost anything for a trade, you're like, well, why does this company do it for free? There's a little bit between the buy and the ask that they get a part of, and that's deal flow. So that's how they make their money.
Gotcha.
And where is your money? Is it in 401ks, IRAs, brokerage accounts?
I've always been mostly self-employed, so I have quite a bit of money in a Roth and a traditional IRA.
Do you have any employees?
No. It's mainly just a small family-run business.
So you should look at a self-employed 401k.
Okay.
In terms of
Solo K.
A solo K is in terms of the main vehicle that you're going to accumulate the dollars inside of. So there's two questions that you would go through. One is, which tax-deferred vehicle is the appropriate one for you? And then the second question is, what's the investments internally? And my guess is that if you compared your Roth IRA or SEP or any other thing, that you'd end up on the solo K is the best vehicle to save dollars on a tax-deferred basis. So I would look at that, and then I would look at the index funds. All righty?
Okay, I will do that. Thank you so much.
I appreciate the call.
Good luck, Tony. And it is interesting when there's just a proliferation of individual traders. And some of these, there's these infomercials and stuff you hear on these different types of trading programs. People talk about how much money they make each day. They follow the trade signals and all that.
But this is I just think they're selling the same stuff to a whole new crop of consumers that we saw back in 98, 99.
Oh, yeah, there's no question about it.
Right?
It's
So
the
you
same
go out
thing.
23 years later, these people are now aged, 23, 24, 25, 26. It just reminds me of what was for sale back then. And every 10 years, this stuff pops up, and we go through one of these little cycles.
So here, here's an interesting article. We've all seen the studies that our pension plans, government pension plans, are underfunded. Cities every year pay more and more of their budget to fund pensions that should have been funded years ago that weren't, frankly. The state, same thing. It's true across the country. Almost not every state, but most states have this problem. San Diego, being no different than a lot of other cities, had this issue. And so what happened, there was a ballot initiative, Proposition B, in 2012 that went to the voters and said, hey, what do you guys think about us freezing the defined benefit pension plans, the old traditional pension plans, as a city, so we have more money for firefighters and for the police officers, blah, blah. We have more money to spend on services. What do you guys say we freeze any new pensions going forward and instead replace them, we'll give them a 401k style retirement plan.
Which is
90% of workers who work in the private sector, that's already what they have.
And this isn't unusual, that this change, it's just unusual for a county or municipality to be doing it. This took place at companies like IBM. This took place at companies like Southwestern Bell, Pacific Bell, AT&T, all of them throughout the years. This is a very normal business practice to convert from a defined benefit to what they call a defined contribution or 401k style plan.
But what happened? Lawsuits. California Supreme Court ruled a couple years ago that had been placed there illegally because they didn't negotiate with the unions first. Then it went back into this court, into that court. And it's starting to look like they got a problem. And it could cost them
millions, hundreds of millions of dollars
of having to
go back and fund these.
I just look at this and it's.
Yep. It's, listen.
It feels like the can's just getting kicked further down the.
Well, this goes along with this. Municipal borrowing costs have hit record highs in the year 2020.
Borrowing costs have hit record highs?
The municipal bond issuance, the borrowing of municipalities borrowing money is at the highest level since 2010.
Interest rates.
And interest rates are lower. They're just borrowing more money. Part of it has to do with refinancing existing debt, but part of it is the response to the COVID and the fact that municipalities are being pressed more and more to provide services.
Well, the reality is interest rates are so low that their interest payments become a smaller and smaller piece of their budgets. So they're like, what the heck? Why don't we borrow some more money? It's the same thing the federal government's doing right now.
Yeah.
Interest rates are so low. It's like, what the heck? What's another couple trillion dollars? Because the interest payments, a percentage of the federal government that goes to pay for our interest is so low right now because interest rates are low. Even though we have almost $30 trillion.
You could make that argument, but you're just mortgaging the future. That's all you're doing is you're kicking the can, as you said earlier.
Well, I know if my household could do the same thing if we wanted. I can go out and get a big fat mortgage on my house at a really nice low interest rate. I could probably go out, I can get a new car loan, a super low interest rate, get like a 9-year loan on that thing. I mean,
but while you're at it, you should go get a loan for a big boat too. You get like a 20-year loan.
20-year loan on a boat, a low interest rate, and a motorhome.
Oh, by the way, we can't talk about boat financing anymore. My friend that owns a boat dealership asked me not to talk about it. He said, Pat, don't discourage people from getting 20-year loans on boats. He says it's really bad for my business, so please don't talk about it anymore.
The avid listeners of this program are not getting 20 years.
I know. He did ask me not to talk about it, though.
That's hilarious.
He's a good He's a good friend of mine. He is. Wonder how I treat friends that aren't good friends.
So his worldview is the fun that families have out in the boats. It's like it's irreplaceable. How do you put a price tag on that? And you see too many people they get to retirement age, they have a health issue, they can't do their job anymore, and they don't have any money saved up to maintain the same standard of living.
His worldview is I offer them an alternative, and they're the ones that decide whether they want to do it or not. And his worldview is right. He didn't force anyone to buy the boat. He didn't force anyone to take a 20-year mortgage out on a boat on a depreciating asset. He just offered the alternative, and those people.
I have no problem with the free markets allowing for 20
Exactly. I think
none whatsoever.
30 or 40
I do
year.
have a problem with some of the mortgages that they were doing back in the day. These adjustable rate mortgages, negative AM mortgages, that they weren't sophisticated enough to understand how the products worked.
It had more to do with the consumer than the product itself. The product was too sophisticated for the consumer. It was misrepresented in the marketplace.
Misrepresented in the marketplace. Most financial products, there's a place for it, but they're often misused.
Yeah, fair enough.
Okay? Most time, yeah. All right. Let's go back to calls here because we have calls. We are in Colorado talking with Jonathan. Jonathan, you're with Allworth's Money Matters.
Hey, guys. How are you guys doing today?
Fantastic.
Great. Well, I'm 24 years old, and I'm $42,000 in debt. Now, I'm in between on what should I do. So, to quickly elaborate.
How did you get, does that count in student loans?
Negative. So, just to elaborate, it's $28,000 for a new truck, $5,000 in credit cards, and $9,000 in the collection situation. And I was thinking about bankruptcy, but I know that stays on your credit for 10 years. I mean, so anyhow, I have 3 questions. And if I have time, I would love to ask all 3.
Fire away.
The first one.
But by the way, the fact you're trying to deal with this, good for you. So, and you're 24, you have plenty of time to make up with this.
Thank you so much. I appreciate it. So my first question would be, what should I do with my truck? Should I get rid of it, whether selling it back where I got it, which was in Florida, trading it in for something smaller once my credit is back up, or pay it off aggressively within 2 to 3 years?
What's your income?
Right now, it's at $43,000 a year, roughly.
All right, what's your second question?
The second question would be, what should I do with my collection situation? Should I fight it in court, since I believe and many others believe that heard of the situation, I was treated unfairly, or should I just pay it all off?
I know nothing about the case behind it, nor am I mean, what collections from what?
So I have a collections with an apartment complex close to a popular university in Southwest Florida. It's pretty much to just try to keep it simple. I got screwed over on the lease. It's my fault for not reading through the lines, but they didn't want to work any deal with me that seemed to be reasonable. I told them that I had to work in Colorado at the time, and I called them at least 2 weeks in advance.
Yeah. But you signed a 12-month lease and you left how many months into it?
I honestly, I didn't even get the keys. I didn't even move into the apartment.
You signed the lease, though.
I signed the lease, correct.
Okay. All right. And then the credit card debts, right? So
yes.
When did you sign the lease on the property?
I was roughly around, I would say, August 7th, 2019.
Okay. And
they've turned you to collections already?
Yeah, they took me to collections because I told them that at the time.
Have you tried to make have you offered them any money, the collections agency?
Yes, I actually tried to make a cash settlement with them. Well, no, the collections agency, they told me that the best they can do was drop it down to like $7,000, and I would have to pay it all at once. No payment plans or nothing. So,
this lease, the apartment that you signed the lease on, was it full at the time? Were there lots of openings in the apartment? Were there few? What did it? So what happens is they can only recover for the difference in the amount of time that the apartment actually stays empty. But what they do is yours is the last one they actually fill up because they've already got a lease on it. Oh, so we're going to assume that they're good for the whole thing. I think you should visit a bankruptcy attorney.
I don't think so.
Why? What do you think, Scott?
I think this 9,000 collection, you can probably get away with about $2,000 if they believe you're about ready to file bankruptcy.
And you're going to ruin your credit anyway.
If you just have one...
well, he's got the truck and the credit cards.
The credit cards, not that... You can manage $5,000 of getting your credit cards paid down over it. It'll take a little tightening the belt, but you can clearly do it. The truck, I mean, come on.
Yeah. You answered the question.
When I was 24, I drive a nice car now. When I was 24, I'm not exaggerating here. I had a Volkswagen Jetta that had so many miles on it. The motor mounts were broken. I don't know anything about cars. I drove it literally until the motor fell out.
I remember that.
The engine fell out. I was engaged at the time. I went to buy a used car. My wife's with me. I got the ugliest colored used Camry with velour interior.
It was
burgundy,
purple.
but it was cheap.
It was ugly.
It had low miles.
I was embarrassed to ride in it.
But like
I drove around in a Hyundai that I bought at a repossession lot and had dents in the front quarter, and I actually put new quarter panels on it, but they didn't match. Both sides were different.
I topped that story. I was with Pat. We're new in the business. We're trying to pitch some guy on why he should invest his dollars in our new firm. Actually, it was before we even started the firm. And your bald tires that looked like they should have been replaced 6 months earlier, one had become flat. So when we come out, your used car with the bald tires was flat.
Yeah.
Yeah.
I miss those days.
So the point is, like, Jonathan,
you could get through this.
There's a time to have a new truck. It's not now. Like,
right.
You're not look. You can. This isn't that big of a deal, in my opinion. You sell that truck, or figure out a way to get out of that truck, whatever it's going to take to get out of that truck, and then what's it going to take to get out of this collection? Just let them think that you're going to be filing bankruptcy, and you will if you can't. I mean, if they're not going to negotiate at all, at some point in time, you might just say you have no other choice. So they'll take. My guess is the leasing company sold this thing for $500 or something. The collection agency probably paid $500 for this.
So they'll take anything above and beyond that.
I mean, it's a total guess on my part. I might be off, but and then the credit card debt. You just put a plan in place
and live with it
to get that thing paid off. The nice thing is, Jonathan, seriously, you're a young man. If you've learned from these things, the most important thing is that you don't repeat these. That these are lessons. These are life lessons, and you can build from here. Better to have these lessons when you're 24 than when you're 54. Or 64 or 74.
Look up Dave Ramsey and consider attending his Financial Peace University.
Yeah, so
appreciate the call.
Yeah, and it's well, we were just talking about these long boat loans. They don't really care what it costs somebody how much truck they can or can't afford. So
no,
yeah. So by the way, if you this is even in this midst of this COVID environment when you can't meet face-to-face, you can still, with Allworth Financial, meet with one of our advisors via a video call. Just get a free consultation. We'd encourage you to do it. Go to allworthfinancial.com to learn more about that. We're out of time. We'll see you next week. This has been Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.